This is going to be a lengthy video. If you move directly to the points of your interest, please like and share it with your friends. If you watch the whole of it, you are already doing a favor. Thank you. If you're really interested in the type of stuff we are creating and want to appreciate, please subscribe. Else, don't worry, it's on us. Hey guys, this is Gold. Lately we have realized that we made a mistake. Don't panic. We didn't do anything wrong. It is regarding order of the videos. But some things you learn as you grow, as you mature. This video is all about the gold stuff that we should have done in the starting. Now let's not crib about it and start paying attention, because I told you, this stuff is gold, man. We totally understand if you start shouting that why we just trade in options when it is risky, so complex, and when it gives mental trauma to calculate the winning positions. Then why options? But with this mindset, trust me, you are unknowingly blocking yourself from the very intuitive learning of our professional trader series. You're losing all the benefits we brought for you through our Telegram channel. But I know you guys are irresistibly stubborn, right? That's why I put forth not only 2, not 3, but 6 points to help you understand the beauty of options, which once was dreaded for all its complications. And if you understand it good enough, it is such a powerful tool that it has the power to create many rags to riches stories. No pun intended. I seriously wish you don't watch till end, cause if you do, it will be like swimming with the dolphin, flying with the eagle, or cycling with me, of course. You will just fall in love with the options. I don't say we will crack options up for you, but yeah, it is more like it. So before sharing these 6 golden keys, let me show you a trailer of the upcoming blockbuster, specially prepared for you. The trailer comprises of 2 parts. The first one is what different asset classes are typically used to increase wealth and what are their returns. The second and the most important one is the distinction between stock, futures and options in terms of capital and risk management. First aspect, gold in past 10 years has grown at the rate 6.2%. Your 1 lakh turns into 1.82 lakhs. Nifty in past 10 years has grown at the rate 9.13%. So your 1 lakh will become 2.39 lakh. For PPF, it grows from 1 lakh to 1.98 lakh. In FDs, your 1 lakh becomes 1.79 lakh. Now see the potential of options. Just see the screenshot of our Telegram channel where we have achieved 89% accuracy in our trades, and most trades have potential to generate much higher returns than the above mentioned asset classes. And see for yourself, options have the potential to generate the above mentioned 10 years returns in just 1 year, only if risk, capital, strategies and trade plan are managed properly. Now coming to second and more important aspect, that is the distinction between stock, futures and options in terms of capital and risk management. As you can see in the first table, to buy 250 shares of Reliance that is trading at 1900 right now, you need rupees 4,75,000. If it goes up or down by 10%, you'll make or lose rupees 47,500. In case you want to take similar position of Reliance in May futures, you'll need rupees 1,10,000 to initiate the trade. Now if share goes up by 10%, then share price will be 2,090. And in this trade you make rupees 43,750, which is 40% return on capital. And in case share goes down, you have unlimited loss. Yes, you have unlimited loss, and you need to deposit the same as mark to market. We also call it M to M. Similarly, if you are trading in Nifty, where spot price is 14,341. May future is currently trading at 14,385. Margin required to take this trade is rupees 1,60,000. Now if index goes up by 10%, that is 15,824, you will make rupees 1,07,888. That is 67% return on capital. On downside, here also you need to deposit M2M. But coming to options, to take benefit of the same move, you can buy Nifty May 14,400 call by investing just rupees 28,800. Now if index moves to 15,824 by May end, you will make rupees 78,000, which is 171% return on capital. Great. Here maximum loss is fixed at the amount paid to enter the trade, that is 28,800, since this is just a buying call. Now you can imagine that using option strategies can provide greater risk-adjusted returns. With this in mind, let's begin with 6 reasons to trade in options. Mark 1. Low capital requirement. This is the first and major benefit of trading in options. We need much lower capital to implement very basic strategies and benefit most out of it. We learn better with examples, so let's go. For your information, table on the screen is the screenshot of Nifty May series option chain from NSE India website. Carrying forward our earlier Nifty example, where Nifty index closed at 14,341 on 23rd April 2021. Let's say you feel that market may go up by 2 to 3% till May end. You apply bull call spread strategy. Here you enter this trade by buying Nifty 14,400 call and selling 14,600 call. You just need 51,000 rupees, just 51,000. Once you enter the trade, the margin required to hold on to the position is rupees 21,500 because you receive premium by selling 14,600 call. Here the profit percent can spike up to 33%. Okay, I understand you need one more. There you go. If you feel market may go down, you can use bear call spread strategy on Nifty, of course. To enter this trade, you will need 55,000 rupees. But once you enter this trade, the margin requirement is again just rupees 30,000. And the maximum profit potential is 23%. You can see that simple strategies can be created with small capital without compromising the profit potentials. These were examples of easy option strategies. If you don't understand this, don't worry. We are preparing a series of basic options trading strategies for you guys. Mark 2. Customization of strategy. Customization is the second benefit of trading in options. You can customize your options trade based on, first, directional or non-directional. By directional, we mean that the movement will be in one direction. When it is non-directional, we are not sure about which way the index will move. We instead define a range. It is simple, right? For a non-directional trade, we can use Nifty short condor, where we short 14,100 put and 14,500 call, and buy 13,900 put and 14,700 call. Now, till the time Nifty stays between 13,942 and 14,657, we won't make any loss. And if Nifty stays in the range of 14,100 and 14,500, we make 25% profit. Second point, you can choose different combinations of expiry dates like weekly, monthly, yearly in case of index. For example, you can create a calendar spread strategy. Point number 3, we can generate regular profits on shares we already own. We have actually explained this later in detail. Point number 4, it further helps in reducing your cost to own stock or index when you want to buy it at lower price. In this example, let us suppose you want to buy Reliance 250 shares at 1800 per share. So what you do? You short June 1800 put, which is approximately 2 months away, and you receive a premium of rupees 46. Now, till the time share is trading above rupees 1800, whole of this rupees 46 is yours. And as soon as the stock comes below 1800, you can close this position and buy the stocks. Through this, your cost of ownership will reduce by 2.55%. If the share is still trading above 1800 till June, then you can short 1800 put again next month and get the premium. Gradually, your cost of ownership goes down. Mark 3. Leverage. A huge benefit of trading in options is the ability to use leverage. Of course, leverage is a very dangerous thing for those who don't know how to use it. With the help of an example, we try to explain how leverage can be used in options. Let's say you want to own 250 shares of Reliance. That will cost you rupees 4,75,000. Same benefit you can get by owning 1900 calls at just rupees 26,500. Do you see you are in control of these shares at just a fraction of your cost? Now, from return perspective, if price of Reliance share moves up to rupees 2200 by 24th of June, return on the 250 shares you bought will be rupees 75,000. That is around 15%. But at the same time, return on call option you bought will be upward of rupees 48,500. That is 183%. But yes, if stock price remains same or falls down, you lose 26,000 bucks. Mark 4. Probabilistic trading. Benefit number 4 of trading in options is that you can choose your probabilities. When you are trading shares or futures, the probability of making money is 50-50 in the short term. Of course, over a longer period of time, shares have higher probability of making money. Historically, let's say you buy one lot of Nifty after a month, there could be 3 scenarios. Either it will go up, go down, or stay at the same level. That means your probability to make profit is 50%. But instead of buying Nifty, I sell a put. Of course, I will hedge my position to control my loss. So I sell Nifty, 14,300 May series put. Now after a month, 3 scenarios can happen again. Nifty may go up or go down or stay at the same level. But now I will earn the premium of rupees 26,584 for selling the above put. Even if it goes down till 14,000, I will still make profit of rupees 4,000. Only after Nifty goes below 13,945, I will start making indefinite losses. But you can easily see my probability of making profit is more than 67% at start itself. And if I hedge my position by buying 14,000 put options, my losses are limited to rupees 14,745. Just rupees 14,745, which is well under my control. You can choose trades based on mathematical probabilities as shown in the table. Here you see that even using same bull-put spread strategy for different strike prices, you can choose the trade based on the probability of making money on your capital employed and expected return. Man, I'm exhausted, and I cannot ask you guys to be the shining armor too. My dear fellas, we are reaching the climax, and all corrupt souls like me keep good things for the end. So, let's get going! Mark 5. Options reduce risk. Benefit number 5 of trading in options is that you can reduce risk as per your risk profile. You can choose trades based on your risk per trade and then initiate the trade. For example, you feel that Nifty is about to fall from the current level. Based on your risk profile, you can create and choose from different existing strategies. An example below, you can choose same bear call spread strategy with different combinations of calls to create high risk trade that can generate higher returns. Or you can choose low risk trade with low return. Here, when you create bear call spread using 14,400 calls and 14,900 calls, returns can be 20%, but it is risky. If I want to choose low risk bear call spread, I will use 15,200 and 15,300 calls. A great news for all. Even stock holdings can be complemented with options. Combining these two can create a very powerful force. May the force be with you. Examples of such strategies are callers, short puts, no, not short puts, short puts, my English, short puts, covered calls, and protected puts. They complement long-term stock investing. And finally, Mark 6. If you love market, options are for you. By very nature, options are more short-term, which means you can have more exposure to the markets and economy. Markets in general are fun, and there is really nothing that comes close to the freedom and flexibility of trading in options. I want to conclude my talk with a simple message. By developing your own trading system and using different option trading strategies, it's next level. We guarantee you. If you take the plunge and start learning options, you're gonna enjoy it. Thanks for bearing with me. Bye.